I think we can start. Yeah, let's start. Okay. So, hello everyone. How's the midterm week? I hope thanks for showing up, even if it's like a busy week now. But I believe this session would also be helpful for you. I'll probably end little early, but we'll see what we can cover in the time. So, uh, quickly some announcements. Yeah, so first thing is the next session would be from WorldQuant. Uh, the the two people here are coming all the way from New York to address all the students who are participating in international quant championship, and in general, knowing about how alphas can be made, benefits of participating, and about WorldQuant itself. So please do show up for this one. If there is like enough people in the class, like I'll give extra credit for this also. So it's like a cumulative thing. But it would be here same time as the class. Um, and yeah, so that's one. And then other announcement is the quiz 3 we released yesterday. That's available on Canvas. It will be due uh, in a week. Same format, same timing, like 2 a.m. Do not misinterpret that 3 a.m. time which appears on quiz. It's in Mountain View time, so it's like 1 hour ahead of us. Um, and then moving forward, like we'll do mostly stocks trading and coding part. Like we are done with options. I know it was like a bit of a theoretical side, but that's very important to know because like you should take that out of like a quant finance course. So we covered that first, but now we can focus on like stocks and trading. So a quick recap of what we covered in previous um, lecture. So that was around Greeks. So we started with theta. Theta, as you can see, decreases the options value with time. And then it varies itself. It is maximum in magnitude at the nearest point to expiration value. So you can see here 50 is the value. So it'll be around like 53 or something, which is maximum. Um, so that's called at the money. And if you are in the money, that means you're making profit out of that option. So you're in the right region here, and you will have a profit. So that's called in the money. So again, the theta decreases in magnitude for that region. When you're out of the money, that is like when you are just starting, it does not vary much for a little bit of time. So it will remain like very close to flat line. Then at the price of the stock itself, the current price, so that was 30. If you're trading around that point, that is the time where it starts to like increase in magnitude because now your theta makes impact on the option price. So that was theta. Delta was the change in options value due to the change in stock price itself. So that's like the most important factor, I would say, in like influencing option pricing. And you'll have some like good questions on this in quiz. Pretty straightforward, but most interesting. And then, so how do we use these data? We try to create like a portfolio which is neutral. Delta neutral means you are basically trying to minimize your risk by making such a portfolio. So contracts particularly have delta of plus or minus one. Everything in between is like every other options have between plus or minus one. Um, so this was like example question. You can quickly go through that. Gamma is our rate of change on options delta itself. So for any like change in $1 of the stock itself, how much delta changed is the gamma. So you can like keep going and try to create a portfolio which is like delta and gamma neutral. Can also create a vega neutral. So it's like how much you want to like make it robust. You don't always want to do it, but it's like something that you should consider when you are trying to minimize risk. So how much risk you should take. So that was gamma and delta graph comparison. Implied volatility is a forecast of the future market. So and here we will use that in vega, because vega is sensitivity to the implied volatility. And we gave a formula of it, I think. Yeah, so it's the rate of change between options value uh, by the implied volatility. Um, so that is vega. The rho was change due to rate of interest. So banks or like the US government may change the rate of interest. So that also impacts options pricing. So that was about all the Greeks. And then finally, like what all is the use of it? This is the most like well-known model for option pricing. Black-Scholes. It considers all these Greek variables, and then you can create like a formula using these uh, of the Black-Scholes, so that you can calculate the options true or like value which is more close to what is a fair value. So see, here is the options value, and other Greeks help you calculate it. The important part is the normal distribution, the log normal distribution here, n of d1. So d1 is defined as this, and this is d1 is coming from our Greeks. So that's where Greeks come into role. S is the stock price, K is the strike price, T is the time. So that's all about Black-Scholes. We did an example here, so you can see that. Um, and lastly, I would say it's not like a straightforward process to calculate implied volatility. So what you do is you first see, okay, what's the current options price in the market, and then you calculate implied volatility using it. So and then you keep going back and forth. So like doing a reverse engineering to like find out what's the correct implied volatility, and then you can like interpret your fair value of options. So everyone may have a different value coming from it based on what sigma implied they have used. Okay, so that was about Black-Scholes. And Black-Scholes is based on several assumptions which I wrote in the previous slides. Uh, and mostly one thing that's improved currently in that model is that you take into account that volatility would change over time. So markets become more or less volatile. In Black-Scholes, we have assumed it constant. So there are models which assume stochastic volatility. So that was previous session. Now let's continue to. I little bit talked about moving averages, so let's continue that because that's gonna also be important in your like alphas that you create. So moving averages, you can quickly scan the QR code for that link, which is to that Google Colab where the repositories, and this is the attendance form. So scan both of it. I'll give a minute. Oh, okay. I think I forgot to share screen. Sure. Okay. So, okay, I hope everyone's. did scan it. Done. So let's go to this file now and see how this moving average is calculated. So uh, moving average simply is like you are taking averages of certain number of points, but you are doing it successively, right? So you are doing first 5 points, basically January 1 to January 5, you calculated a average price. Then you did for January 2 to 6, then 3 to 7, so on. So your points are representative of like 5 days of stocks movement. Um, and that is considered a indicator for like how your stock is moving over time, as compared to long term. So if you're calculating 5 days of moving average, you're basically considering a short term average. And if you calculate for long, like 50, 90 days, then you are seeing like a long term average. So the main idea behind this strategy is if you see a short term moving average higher than your long term, then you can guess that the stock is in a profitable uh, trend, or like it's going uh, more than what it usually does. So that's like a buy signal. So you should buy that stock. Otherwise, if it's going lower than average, then you short it. So you want to sell that stock. So how the code works here is you first install library, that's Condal, and this point where the short term moving average is about equal to long term moving average is called the golden cross. And yeah, the one where it's below the long term, it's called death cross. So golden cross is like, oh, now you are like in a buying signal, and death cross is when you are like having um, sell signal. So you don't exactly have enter the market at the point where it's equal. You have like a deviation from it. So you consider that, okay, like small noises can be there, small little movements. You won't want to trade every time. So you consider a threshold, like, okay, this is the um, amount of difference between short term and long term moving average. If I see at least this gap, then I will create a buy signal. Or if it's lower than, like it's a negative one, then you'll do a sell signal. So that's where death cross and golden cross are. They are not at the crossing point, they are above or below, right? So now, one thing you have to do for like using this repository by itself is you have to like get a API key from that link. You can do it that for free. It's just you need to do it once. So I'll upload mine. You have to go here and see. Okay. Yeah. So once you do that, it it will work out. You just need the API key inside that file. So you can create like a empty file, write the API key in the format they suggested. I've written it here. It's just API key equals the key you get, and then you can use it. So now let's get the Microsoft data from this library, and so we can see all the prices, open, high, low, close, their volume and everything. What do we care about now is the prices. So what we are doing is the short term moving average for us is 50. So we are taking like 50 days or so of average. Long one is 120. Um, so now we can create signals using it. So initially, we are just assigning it a 0, but later on, a signal of 1 would be a buy signal, and a signal of 0 would be a sell signal. So this is the main like line where we are actually calculating the moving average. So the short term moving average is the um average of uh, short look back. Rolling is what creates this moving average, and you're taking mean of it. So you're taking the rolling sum, and then you take its mean. So that is about that line. Now there is one another parameter here called min periods. So let me tell you. I think I noted here. So the exact, yeah, so that is for points that, like, when you calculate the average, you're losing some points, right? It's starting from little ahead of what your first stock price date was. So what you do is the min periods equal one ensures that if they're like fewer than short look back or long book look back data points, then it still calculates the average. So it still calculates whatever the average is before those points. Um, so now the next thing is this line where it says NP dot where uh, short term moving average greater than long term. So that's where you would compare average and put a one, um, otherwise a zero. So that's where you assign buying or selling positions. So let's oh, short term. Okay, I didn't run the previous. Mm, okay. Okay. Um, and then the next line says you are uh, basically removing any rows of data before the short look back because you don't want to care about it. So I location is the index you're starting with. So you're starting with short look back index and going till the end. So that's just like data cleaning part. Now we have already created the signal here. Now we want to like plot and see where those signals are. So what you do is you use matplotlib. um, so first line gives you the moving average plot of for short term, uh, and then second would be long term, and then you label all the prices, and then X and Y are where your signals are generated. So um X is the position of your uh, buy signal, I guess. Here, the marker, the caret symbol symbolizes the buy, and the V symbol symbolizes the sell. So if you see the plot here, um, you will recognize some signals. Let's see. Oh, these are just plots right now. So uh, let me rerun positions, signal, and then this. So if you zoom in, you can see the blue signals, which are the caret symbol. Though that's like a buy signal. Uh, the orange one is the sell one. So you can see kind of how that signals may be adjacent also. That's because uh, you like have a steep increase and then you have like a steep decrease. So that symbolizes that like stock is going down, you should probably sell. So that happens a lot. So you're basically having like a pair of these signals together if the stock is like not so stable, moving up and down. But otherwise, in general, you can see the moving average is going down. So this is like more of the sell signals, I guess. So how to improve this? Like when we calculate a simple moving average, it's just you're taking average of the 5 past points, right? But you're weighing them the same. So whatever happened 5 days ago, you're considering that equivalent to the one happened yesterday. But that's not true. What happened yesterday is more important because that was the most recent market sentiment, and that was the most updated version of the stock price. So what you want to do is you want to consider those recent data points with a more weight. So for that, you can use the exponential moving average, EMA in short. And what it does, it weighs your newest or recent data points more. So the only part in the code which is changed is this EWM. So EWM is exponentially weighted, uh, like averages. So it automatically does it for you. It's like exponential graph. So the most recent is the one on the top, and then it decreases till the day 5. So if you do that, you'll see a different graph, but it's more representative of the market, or like the trading signals built are better. So you can see here a little bit change of signals. I see a more closer signal here. It's like a consecutive one, and then here also you can see a close one. So they are different from the one above, and if you try to follow one versus other, you'll find that exponential kind of works out better. So that's the task for this simple like averages. Now this was whole in Python, right? But in the WorldQuant portal, you can just do this in a like 1 or 2 lines of code. So that's very useful. But I just wanted to give like idea of how to like how does that code work in background. Like this is the Python code. You can probably understand better. Any doubts in this? Okay. So I'll go and show you how to do this in the World Con portal also. Um, but first, let's like learn some other strategies and then we can implement together. Um, so going back to the strategies. So first trading strategy, it's called reversion theory. And what it says is that if prices that have moved substantially away from their historical average, they are expected to revert back. So that's what we recently saw, right? We had a pair of buying and selling signals very close to each other. So basically, when we are saying that the buy signal will be followed by a sell signal. Why? Because they are trying to revert back. So the stock is not like something like huge has happened. It's like just moving up and down consecutively. So it's like if it's going well above average, it is expected to return back. So that's called reversion. So it's coming back to the price uh, that originally was. And so then what you want to do is you want to see, okay, if it went above historical average, you want to sell it, right? Because now it's gonna revert back. So um, the code for that, oh, I think I did not include, did I not include the code? Okay. Let me pull the code from here. Mm, hmm, okay. Um, mm. Okay, it might be just this. Let's see. Okay, so yeah, let me, oh, screen sharing. Okay, so ignore the other part here, but mostly what I want to show is how do you hmm, do I zoom there? I not zoom. Okay, so um, if you think of it, the moving average I talked about is if it is increasing um, over last 2 days, so we are taking 2 days average and it's like going above average, it may decrease in future. So basically a reversion theory. So what we are doing is we are comparing like the companies who are moving very above average and you want the reversion. So simply what you can do, you calculate their recent gains. So ts sum um, delta. Okay, I think I, I should have taken this example later. So what works here is ts delta is the increase or the change happened in the stock in the past, the days you input. So I'm taking one here. So in the one day, whatever change happened in the closing price. So that's the input parameter you need to take. If that was greater than zero, then uh, you're you're changing it to ts delta close one to zero. And then 14 is your like another long term average. So you're taking 14 days here. So similarly for losses, and then you calculate the rank of it. So let me go over these first, like the parameters itself. What are those? So mm, yeah, so simply what like you can do if you want to like see what these operators are, so you go on simulate and you go on learn, and here you will see uh, data and operators. So I think the screen sharing might have mm, disabled that. Yeah, so if you go on data and operators, you can see what are the operators description. So first one that we talked about is rank. This is the most important one we use. Uh, Rank is basically you are comparing, let's say, 10 companies um, through some kind of parameter. And now you are ranking them based on your strategy. So let's say I'm comparing these moving averages for all the companies, and now I want to rank them that okay, like this was the company outperforming the moving averages among everyone. So what rank does is it gives you a rank, like rank of higher value would be someone who is outperforming, lower one would be someone is not performing well. So it would range from +1 to -1, or +1 to 0, whatever, but basically it gives you a descending order. So if your strategy is uh, saying that you need to buy if the rank is higher, you would use just as is the TS rank. If not, if like it's a reverse one, so then you can just put a minus sign and your order is changed. So that would be your negative ranks. So let's go back and see like some more basic example, and we'll come back to this one. So the other one was like about liabilities. So if uh, so one parameter is called fair value accounting. That means if your company's liabilities are increasing, so that means the company is bearing more cost of loan on it. So this is deteriorating the company's financial health, right? It's getting under loans. So that indicates that you don't want to invest in those companies, right? That's just like a simple strategy. So what you'll do, TS rank operator again here, and sell stocks when there is an increase in their liabilities. So it's the opposite strategy, right? When you rank them, you will see highest rank of the company which is more under the loan. So you don't want to invest in them. So I have put a minus sign here. And this whole operator, or you can say like a data label, is the liabilities data label. So that's just given to you. Don't have to like extract the data from anywhere. That parameter just gives you that data. So it's very straightforward when you like try to implement these strategies in there. You just need to find where these symbols, like what's the description of each of those symbols that you want to uh, make a strategy about. um, One other thing is neutralization. So there are four types of neutralization in WorldQuant, or in general also. The first one is the market. So market is in general the whole market, all the companies which are present. Sector is the second one. It's like a subdivision. So let's say you are considering technology as like a sector. So you'll only see like technology companies, not some let's say like a sales service company, right? So that's a different sector. You are considering technology. Then you come into industry. So industry is, let's say, semiconductor industry is one. So you'll see all like Qualcomm, TSMC, all those kind of stocks which are related to semiconductor. Then you are in the sub industry. Sub industry is when you are like even lower, very specifically seeing, okay, who makes these kind of chips, who makes like instruments for producing chips, all those. So that's like a hierarchy where the highest level is your market and the lowest is your sub industry. So in those alphas that you create, you can create the setting. So if you go on settings, you can see neutralization. So you can choose which one you want to trade about. So if you are very specifically considering that, okay, this strategy is applicable to only this specific industry, then you should choose sub industry or industry. And if you are thinking that that's like a general point, so if you are considering like, okay, like these the alpha just we talked about was more so about loans, right? So the loans can be beneficial to some other companies as compared to others, but it is overall a general idea, right? If you are under loan, your financial health is not so good. So then you can select a higher level of hierarchy to see if your alpha works better. What I have seen, it works well in some industry, so that's what I included in the slide. But you can change and see how that goes. So that was a liability one. So when you run it, you will see your like testing status. So you won't pass tests in one shot. There are like 7 tests about to take care of. And the most overall score, or the most difficult one to pass, is the fitness one. So fitness one is your like how strong is your strategy, right? It considers everything, like every other score. So when you run this, let's say uh, I run this strategy here, then I'll see some kind of scores. And those scores represent how strong is your alpha working in different types of conditions, different type of parameters. So uh, I'll talk about those when they show up. Any question on the like strategy itself, like this liability one? I guess it's pretty uh, straightforward on what we are doing. Um, 252 here is the number of days we are considering ranking for. So we are considering the ranking based on the past 252 days of data. Why 252? Because that's the v- considered like amount of trading days in a year, right? So you have 365 days. Saturday, Sundays are off. So you remove those and some holidays. So like national holidays and so. So 252 is the number we consider as like a year of trading. So we are considering a year of data of liabilities and ranking it. So let's go back and see how strategy worked. Okay. So see here. Yeah, so here now you can see like a profit loss chart, how your strategy worked. So overall, there is an increasing trend. You can see like you're basically making some money out of this, but there is downfalls also. So how well that performed is given by these parameters: sharp, turnover, fitness, returns, drawdown, and margin. Um, you can see how these parameters impact your strategy by like you can I would recommend like reading about it on your own, but I'll just explain in a bit that drawdown is like how much maximum loss your trading strategy can occur, right? So here you can see if you see like a huge drop, right here you can see a huge drop, here you saw a huge drop, that impacts drawdown. So like how risky or like how much loss your strategy can make is reflected on your drawdown. Returns is on average how much profit you made. So it's like 2.7% or something here. Fitness is your overall score, how well your model fits the actual prices. Turnover and sharp, you can read about more. Um, just like by definition, I'll just share quickly what are the sharp ratios. These are very like common to see, but it depends on how you want to improve, right? So sharp ratio is just this formula I didn't include in slides, so I'll just show that here. It's like expected value of your um, asset minus risk-free return. So what your asset is returning and your risk-free return are subtracted, and you divided by the sigma, which is your standard deviation. So it's a simple sharp ratio is like reflective of how like um, risk adjusted value is performing. So um, it compares. This is what we usually refer to like Investopedia. So you can see it's saying that it realizes how your stock portfolio has returns. So it measures the volatility to its risk adjusted performance. So how much your stock is volatile or your trading strategies is volatile when you're making investment. So it should be more. So sharp ratio, like you are aiming to increase so that you're basically not uh, in a very highly volatile uh, trading strategy. You are trying to consistently making profit, not like uh, ups and downs too much. So that's where your sharp ratio comes into place. Now let's go next to other trading strategies. So here test failed was um, 0.83 was fitness. So that wasn't good enough. Um, but if you go into industry, so your neutralization changed to industry now, and your decay changed to 150, days changed to 150. So what I have done is instead of a year, I'm just taking last two-third quarters, right? So 150 days represents like more recent data. I don't want to bother about what happened like 9 months ago. I just want to take care of how the liabilities are for the recent time. So that happens to improve a little bit. Like your sharp is 1.18 now. I guess here it wasn't that high. And fitness is 0.86, which is an improvement over this. So you can see that change also impacts. And the other change I made was from neutralization sub industry to neutralization industry. So you're going on a higher level. You are saying that this strategy is more so general about any companies in an industry, not specific to some sub industry. So that changes. You can try to simulate on your own and see how the strategy works um, in different neutralization settings. Okay, so next one is about operating income. So if the operating income of a company is currently higher than its past 1 year history, then by the company. So uh, if you have a lot of operating income, you have more like liquidity to invest in what resources you want to give to employees, to the clients, everything. So basically, the company is in a good state to invest or make their working services better. So that's the operating income uh, influence. And simply what I have done again is calculated the rank of operating income for past 170 days. So considering past 170 days of data and use the operating income. So now how am I coming with this hint to improve the alpha? I'll just quickly share that. So if you go just like not thinking, you don't have a strategy in mind, but you do want to like, let's say you're just starting off, right? You don't know how can things work in finance. So what you can do is just click on this example, and it will show up one such alpha which can be used. So here it says, okay, it is usually safer to go long on companies that can easily pay back short-term debt using high liquid assets. That's the implementation hint to improve the alpha. So if you are not very comfortable like thinking on your own, this is the best thing you can do. Like they will give you an alpha, they'll give you the idea how it is working and how you can improve it. So probably this won't pass all the tests, like the score, the code they are giving may not directly pass the all the tests, but what you can do is improve on it based on the hint and things that I'll talk more about. So um, this is like a starting point if you are like facing challenges in like thinking about strategy itself. So here the hint that was given to us was how can we um, compare the value directly by calculating a ratio uh, that can improve the signal. So there you can use ratios like operating income to assets, operating to the liabilities, to the debt. So all those kind of ratios would reflect more about, okay, what's the operating income as relative to other companies' um, variables. So you can do that just by like dividing here by some parameter that you think of, and that will probably improve your alpha. So what extra thing I did was like I reduced the days from 1 year just to see how it works. So like the original alpha they gave as example had 252, but they also gave that hint that okay, you should try to see what kind of uh, past history works out best. So for us it was 170 that I thought is best helpful because that's like recent 2/3 part. Um, so that's about operating income strategy. Now, how do we like merge ideas? So as I said, like we want to improve our alphas, right? So just based on what we already did, what we can do is merge two strategies into one by combining their scores. So it's basically like how you are performing in two tests, right? And your combined score is what matters, right? So what we are doing here is we are considering two types of scores or ranks, and then we are taking an average of it, and that's on the basis of that we are ranking the company overall. So let's say some company performed well in the operating income, but their delta is too low. Delta was the recent 2 days of movement. So if it's like going very high above average already, it's probably going to revert back, right? The reversion theory we talked about. So uh, that's the negative one. So if the stock is already moving very high, but also has an operating income which is high, you're kind of not sure about it, right? So it will get a score of like 1 plus like 0.5, 1.5 something. But overall, if other companies having very high operating income, but that stock hasn't increased yet a lot, then you can go and make its score very high. So the overall score would be higher for the other company, and that's what you want to trade more, right? So that score would reflect that. So what you can do is combine these and make a simulation, and then you will see you are now passing like 6 tests instead of 5, which we did earlier, and your fitness is also above what we had above had in the previous one. So that's how you can like pass these kind of tests by improving alpha. Okay, I'll take a 1 minute break, but um, try to simulate this on your own. Like this is very simple, like 3 lines of code. Try to do that if you have your login ready. Okay. Um, so merging the ideas can be done by like adding the ranks we have. One thing I want to point out is the TS rank versus rank. It's basically almost same. TS rank just has this days parameter. So it's like a time series rank. Otherwise, the rank is just you are ranking based on the current data. Time series is like you are considering the whole time series. So you can read about that description in like operators in the WorldQuant portal. So now let's like learn about how to like incorporate these hints that they gave. So the operating income thing we just learned. So if companies that generate high income from operations compared to their debt, so that's what we talked about in the previous hint, right? They gave us operating income alpha, but they gave us a hint that okay, compare it, make that alpha also consider some other parameters which are giving a better ratio. So what we now do is we calculate the ratio of operating income to their debt, and if that is high, that means their operating income is very high, but their debt is very low. So that means the company is like not even in debt, right? It has this operating income from their profits or their income. So that's a very good signal. So that would improve our alpha. So if you do not like cannot think about this just by yourself, what you can do is you can like uh, put that code also uh, in like chat gpt or some kind of ai model, and then they will give you the hint to improve it. So how to improve it cannot be directly understood by language models because they do not know what WorldQuant offers in terms of data or what's the syntax they are using, but they can give you an idea. So then you can look up that data in the list of data and then use it. So that's like a good process to use this like AI advancements in like creating your alphas. So if you just do their example alpha was this: rank the operating income by debt, but by like using ai, what the ai gave was like, okay, you calculate this ratio, do not just rank right now, calculate the average over a long period of time. So that was our hint this time, that you calculate over a long time. So we are doing it for 150 days and then use it, right? So here it was just rank, but basically what we are doing is converting rank into like a time series average, and then we are ranking the companies based on trend of average over time, right? So we are calculating mean of this average ratio uh, over 150 days, subtracting the average ratio which was originally calculated. So that gives you similar to what we thought about long and short moving averages, right? So you're calculating that difference and then you are seeing the rank. So that you just need to like improve your fitness a little more. But otherwise, this alpha is good. But fitness of 0.65 is obviously very low. Like it should be, if you are closer to like 0.8, it's probably like a good strategy. But obviously, you need to cross this threshold of 1 to have that alpha submitted, right? That's what we require you to do also. So try to like create a combination of these strategies that we talked about. I can tell you that among the four that we have talked about till now, there is a combination which does pass the case without doing anything. So like you can use these, but you have to like change weights of it. So currently in the examples I gave, I think I was calculating the average here. Yeah. So when we merged our ideas, we calculated average just by adding and divide by 2, right? If you think that one parameter is more important than the other, what you can do is multiply, let's say, 2 here to the income rank and divide by 3. So you are basically weighing the income twice as your delta. So changing those weights can help you incorporate more like your intuition on how to improve alpha, right? If you weigh more on some parameter, then it's more profit generating, right? So that's your intuition how you can modify. You don't have to like do crazy numbers. You just have to like think about, okay, 2 3 or like what kind of weighted average would be best. So that's about alphas. Now lastly, you can also create alphas for China market. So not just USA stock market. You can also create alphas on WorldQuant for markets like China. And here you would have different test cases. But I just clicked like example strategy, and they gave like a China one. So I just thought about, okay, let's like try to improve it. So here the idea is retained earning is a measure of firm's net income. So how much you earned after giving dividends, right? So you remember in like your first lecture, we talked about dividends. So whenever we give out dividends, the company's net profit decreases. Uh, but what's left after it is what matters, right? So the retained earnings are indicator of future investment. So instead of just using income, you are using retained earnings, and you're normalizing it with shares out. So shares out is um, the amount of shares it has outsourced, and you're calculating delta for that over past uh, 63 days. So that's like 1 quarter. Again, it's not just like 13 to 3. It is the number of trading days. So you can like just divide 252 by 4 and get 63 here. And then use the rank operator again to rank the companies. So I already like took into account the hints they gave and implemented it. So that this gives like a pretty good result. You can see only Sharp ratio is like a little below what we expected. Fitness already passed well above 1, right? We are like 1.17, which is not so usual to find out. So this was a very good alpha. Only thing is the Sharp ratio. So you can try to improve that. But that this was on the market of China. Um, it won't pass on the USA one. Like I tried it, it's very different because retained earnings might be something more applicable to China market. They might be giving more dividends than what US does. So that can impact how your alpha is performing. So that's about this alpha. Now, lastly, as I talked about the sectors, some strategies are meant for big companies, right? So you need to change your um neutralization from market to sector to industry or sub industry depending on what's your strategy. So here, let's say I'm the hypothesis is that companies with higher asset fair value but comparatively lower EBIT are likely the companies have invested over past years um, in the future. So like this can be thought of as like you're buying some kind of buildings, large like assets which are fixed. So those companies have invested more in past, but now it's beneficial to them, right? Now if you go and buy an office in New York, it would be very difficult. But the bigger companies, what they think is think ahead of time. They think of future investment, like, okay, if I make this investment now, how it's gonna benefit me in the future. So the bigger companies try to think of these kind of strategies. So if some companies have done that, those are in a very good state, right? They have made those kind of investments that would be helpful in their future. So we want to use those uh, data to calculate our alpha, or to like make our alpha. So what we do, we rank the domestic and foreign EBIT separately with grouping by industry. So we are grouping by industry the EBIT, both domestic and foreign, and because different industry may have different splits, we are like using only one specific industry. So like let's say financial uh, but this would work very well for the bigger companies, right? So the other setting you can do in the portal is which companies you are talking about. So if you go here, you can see universe, uh, top 3000, top 1000, top 500, or top 200. So if you do top 500, you are basically considering big companies. And that's what we are caring about in this alpha, right? We are talking about investments made by big companies for future purposes. So this would help you make this alpha perform better uh, because of the top 500 like cutoff, right? So uh, this was the alpha that we eventually had. Again, yeah, this is where I was trying to describe the if else statement. So this kind of syntax is basically here a if else statement that you usually see in Python. So if your group rank is greater than zero point 0.5, then multiply your alpha by 2. Otherwise, keep the alpha as it is. So if it is more than zero point 0.5, then you are weighing it more, otherwise alpha. So that's like a if else condition. And that is helping us to uh, rank, like make this group rank more applicable to ranking the companies in the top 500. So you can see about like these operators in, there is a section called group operators. So whenever you want to group uh, two kind of parameters or companies or industry into one simple rank, you can use group parameters, and you can learn about it here. There are like about 10, 15 group operators that can be applied while calculating group ranks. So yeah, that was about this. Now, like if I mean, this is fairly something new to most of us, right? So how we can like think about these strategies outside what the examples they give us. So one good paper that was released by quant researchers working in that company or others was this one. So you can scan that QR code. It consists of 101 alphas, um, and it's in the language of WorldQuant, fast expressions. So you can try to simulate them. They obviously, because it's public, they won't work directly, but those ideas would, right? Those ideas, you can combine them. So add, like merge ideas by taking a rank as a cumulative weighted average, and see if it works better. So what you can do is like just go and copy that alpha to like learn what's the use of it, or like what is the idea being implemented. So one way to do is you go on the WorldCon operators list and see, find out those alphas, uh, and otherwise you can also like use AI models. um, both are allowed, or like both are very good to do if you are thinking of improving. So let me, yeah, pull that paper where, I'll just copy the link. Mm. Oh, so if you go on that link, yeah, so that's 101 formulaic alphas. What you can do is you can copy some of these and see how it works out. So they have multiple operations going in one line. You don't have to do it in a single line. You can break down that code in small parts and think about what's going on. So this seems fairly simple, like using the delta that we did, but it's just a if else condition. Um, so you can like try to break it down into small parts and think about, okay, why, what are we doing as a condition? If this condition is true, then you're doing a -1 into delta of high comma 2. So high means the highest price of the stock over that day. Otherwise it's a zero. So what does that mean? You can like try to search up, or using AI, or you can break down that code using the description of operators, right? So the description of operators here is very important. That helps you break down the code and understand. So you don't have to like, what I'm saying is you don't have to like build strategy of your own, like by yourself. You can take ideas from the existing public alphas that are available and these descriptions, and then you can like combine them using simple operators. Like what I have done mostly is TS rank or something like group ranks to calculate the ranking. And that was most helpful. Like 3 4 alphas were able to pass those test cases. Okay, any doubts on the alphas that we discussed? um I know it's like little different than what we usually code in or like what we think about, but it's something like the first time you create an alpha would take time, uh, because your test cases won't pass. You won't understand what's sharp, what's drawdown, what's margin. I purposely didn't mention in class so that you go and read about it, and you like improve upon those alphas. But I've given a plenty of these like alpha examples, so that you can refer them. One other thing is, if you go on WorldCon like challenges or teams. Yeah, so like if you want to form teams, I have seen that most people here like just registered themselves for now, but you can like post on Piazza about, okay, like you're looking forward to collaborating with someone. The teams are allowed up to 4 for this, and it's very good to have like several ideas uh, to create these alphas, because everyone thinks in a different trading strategy. Everyone has like a different kind of experience, with someone having a coding background, someone having econometrics, some finance. So everything is helpful here. Data analysis. If you want to like analyze these graphs, that would also be very helpful. Like when you simulate, you get this profit and loss charts, right? Those are helpful to understand how your alpha performed in like specific time, with sharp ratio, how much it performed, how much was the profit and loss. So those help a lot in thinking about, okay, where should I make the improvement? What's the part I'm lacking on? So try to do that together as a group. That would be very much appreciated. And then I believe, I know this is like a midterm week, but if you do get time, try to practice this in this week, so that when the next week WorldCon comes here, you like have already some background. You can ask them questions which are you are facing as a challenge, or like if they talk about something very deep, you can understand what they are talking about. Feel free to post questions about like these in the Piazza, so that we can also like share insights to all. So yeah, here you can see the chart of profit loss. You can also see Sharp. So Sharp ratio here is not performing that well later on. You'll see that a lot in like, so that the time of 2020 to 2022 was the COVID era. Lot of things kind of change here. Some stocks perform very well. So that when making alpha, because they are testing on like 5, 7, 10 years of data. So that would include the recent time of COVID. So do try to simulate some of these, at least the ones I've talked about in lecture. Try to change their weights, see if the rankings, like combined rankings, work better. Okay. Um, all right. So that was it. Um, for hoodies, if you haven't taken hoodies yet, you can take that at the back. And we also have food in the back. So please take, even if you want to take, you can take home. Uh, so take it. Right. Thank you.